Historically speaking, when the markets turn south, there's one asset that stands to benefit. And our subscribers just recently closed out a 226% profit on it from the last market hiccup. Click the button below, and I'll tell you all the details on this natural hedge that you need to add to your portfolio. Trust me, you'll be happy you did when the next shakedown happens. Hey gang, it's Thursday, October 10th, and I want to talk about jobless claims. That was the big report of the week, actually. And guess what? 210,000, the consensus range was between 210 and 219,000, and we came at the lower end of the range. What does that mean? That means economy stable. Look, we're below the moving average, which is at 212.75 thousand. So that's telling us economy is moving along, and there's really no evidence of a slowdown. And if there's no evidence of a slowdown, why is the Fed lowering rates? And that's what the bond market says. The bond market went lower, gapped lower, 2.23 points, which is 1.54%. And that's a down move in bonds, which means higher interest rates because there's more evidence that economy is not slowing down. So if the economy does not slow down, bonds go lower. If economy is slowing down, if there's fear in the economy, stock market goes lower, bonds rally. So we're seeing the opposite of that. We're seeing like an amazing consensus range, 210,000. I mean, that's just a great number. That means there's nothing to worry about. And what is the Fed now going to say? What are they going to say? What they've been saying before. We're going to keep lowering rates because maybe, possibly in the future, economy will slow down because of China. I get what you're saying, but right now, not seeing it. So what did the bond market do in reaction to this report? It gapped down. Am I expecting this gap down to stay? No, I'm expecting bonds to react. Nobody was expecting the numbers to be that low, if you want to know the truth. So how did the stock market react to all of this? Let's look at the stock market. That's the E-mini S&P. We're at the 50-day moving average. We don't have any major news this week. Tomorrow's Friday. Next week, we have a full plate, but in the meantime, as you can see here, the S&P is not in a rush to move away from this trading range. Remember, I said the S&P does two things. It either congests for a long time, it just sits between the 200-day and the 50-day, or goes down and comes up, jumps back up. Like this. Not seeing it at all. I'm seeing, again, congestion. Congestion. And if it remains, there's a good chance the stock market will just kind of sit tightly. Right now, consumer stocks, utilities, consumer staples, and retail are the top three sectors. They're all defensive. Furthermore, if you look at the small caps, which is a much broader number of stocks, and stocks that are more impacted by, but greatly impacted by China. I don't know what's going on with my tongue. I can't speak today. They're coming off oversold territory. We're right at support level. So there's a good chance we may see them rally a little bit, but not too high, which may give the S&P 500 some support and cause it to go a little bit higher. But again, don't expect a wild runaway trending market. Now, what you need to know. Bank stocks start reporting next week. The expectation for earnings on bank stocks has been beaten down. Oh my God. I mean, it's just beaten down like there's no tomorrow. Why? Because interest rates keep dropping. Interest rates are near historic lows. Bank stocks make money off interest rates. So bank stocks are beaten down. The expectations are really low. Really low. And that tells me there's opportunity. There's opportunity because if the numbers start coming out better than the beaten down expectations, we're going to see a rally. So keep your eye on JP Morgan Chase bank stocks next week. And on Monday morning or Monday afternoon, I'll give you the expectation number and you'll be checking the bank stocks and they'll say, well, we came down minus this or minus that. And it'll give you a good gauge of comparison to see what the expectations are versus the actual numbers. I believe we're expected to be down 14% from a year ago on our numbers. So I believe we're expected to see 14% less. Don't quote me on that. I'll confirm that on Monday. Tomorrow, again, expect more congestion, more sideways trading. Expect the S&P to be glued to the 50-day moving average or trade between the 50-day and the 200-day. Until you start seeing the Russell start really giving you upside above the 160-ish level, Because look for how long it's been just range bound. I mean, this thing's been range bound. I mean, look at this. This is China. A year, nothing for a year. And unless we start seeing progress, we're just going to continue seeing the sideways trading action. So, bull put spreads on the Russell 2000, not such a bad idea. S&P stay defensive, iron condors, income strategies, and if you're going to go long, if you're going to go speculative, stick to consumer staples. You'll see why in a second. Look how close to the highs we are. And we're above the 50-day moving average. Or utilities. I know it's boring, but they've been trending higher. Look at that. That's the 50-day moving average. Notice we're above. Now take a look at technology. Or actually take a look at consumer discretionary, which is similar to technology. Not doing that well. Look at this. We're below the 50-day line. So defensive stocks are above the 50-day line. Right here, that's the 50-day line. And speculative stocks like technology and consumer discretionary stocks are not. That taken into account with the fact that small caps are literally like, I mean, this is a year. Look at this, a year. You need to see an upside above 160, 161. Otherwise, congestion, sideways trading range. This puts amazing amount of pressure and weight on the S&P 500 and makes it really hard, like really, really hard for the S&P, this is the S&P, to move higher because all these smaller stocks are putting pressure on it. And that's why the S&P is literally glued to the 50-day line. So don't expect a lot of upside. If you want to go long, stay with defensive stocks, bonds, consumer discretion, consumer staples, or utilities. And here's the ticker symbol for bonds. They look like they're pulling back to the 50-day line, which makes them a really nice opportunity, potentially right now, for a long run, especially if the S&P continues doing this, just moving sideways. I'll talk to you guys later. Take care. Have a great weekend. So the markets, well, they're a bit sideways, but there's no need to worry because there's a whole other side of the market that I want to show you today. Over my years, I've identified a handful of trending assets that are always moving, no matter what the S&P or the Dow are doing. They're completely uncorrelated. That's the word of the day, uncorrelated. But here's the best part about them. They're more predictable than ever. Tap the button below and see my #1 strategy on these trendy ETFs.